The 21.25% is calculated using the $28.19 value in the progressive leg break-even, found in step 3 of the strategy called Step 3 Call Sale times 2. As before, the strategy immediately looks to generate cash flow by selling calls against our long shares, which at this point is 1,400, due to the two separate put assignments. Note this window at the top of the platform, which reads Step 3 Call Sale times 2 until called away. This tells you the next step that you should be taking within this strategy each time the outcome fields are correctly populated at the end of each step. The times 2 is simply referring to the call contracts sold on the two assignments, 14 call contracts to be sold in total. This generates a nice $1,022 in premium, and we have given ourselves some upside should the stock wish to rally by selling the December 32 call strikes. In this example, the stock is currently at 29. To finally close this trade out, we will populate the T3 platform with an ending value in December of 33. We had sold the 32 calls, so contractually these shares are now called away from us, and we use the drop-down menu in the Outcome field, selecting Called Away. As before, when a new leg or step is added above, the current values are populated in the charts below. Here are the current progressive leg price, which you'll see in black, and the progressive leg break-even, which is shown in brown, values reflecting the ending stock value of $29 and $28.19 with the latest call credit factored in. By adding a check in the percentage move protection since inception, you can also graphically plot the increasing progression of your downside protection. A 21.15% move from the opening price of $35.75 is a nice cushion to work with in the event SanDisk doesn't immediately rally. Compare that to a trader who decided to just go long the shares at the start price of $35.75. Having the ability to model out these what-if scenarios prior to committing your hard-earned capital is invaluable when trading options, especially when considering a strategy such as the TAC trade. This application can accommodate two additional Step 3 Call Sale times 2 legs for a total of 3 Step 3 what-ifs. The core value within this entire application is in producing what-if results, and the second graph delivers customizable metrics and comparables by checking or unchecking the boxes. The first and most used output is the cumulative trade progression. It measures the step-by-step cumulative profits or losses over the life of this trade. Note how this trade begins. At the end of step 1, the strategy produced a modest loss of $189. In step 2, step 2 continued that trend, with the losses increasing to $1,694. Then in step 3, which is the step 3 call sale times 2, SanDisk finally rallied and the stock is called away, producing a $3,528, or producing $3,528 in profit. What you can't see is a substantial part of this application where those values are calculated. and then use to populate these graphs. Along the bottom of the platform, you'll see a slider, which you drag to the right to see the hidden columns. If you're watching this in PowerPoint, you don't have to do anything, and if you're watching this in YouTube, you're just going to see this advance automatically over the next 16 slides. Another fantastic metric is the cumulative premium collected. What's truly eye-opening is the direct comparison of our overall profit via the cumulative trade progression relative to the cumulative premium collected. Let's take this even one step further. The cumulative premium collected has been unchecked, and in its stead we have checked on the percentage profit due to premium metric. This clearly shows the end user that of the $3,528 in profit, 80.16% of this was due to premiums collected from selling the options contracts, calls and puts, not from price appreciation. If you recall way back at the beginning of this tutorial, we mentioned that we would return to the importance of the number of positions field, which is a user-defined variable. We populated the application with a hypothetical value of 5, and here is where you can visually see the benefit of diversification with this strategy. Starting capital stress test has now been checked on, which shows you the max drawdown in percentage terms of your starting capital, which is a hypothetical $100,000 during the life of this strategy on SanDisk. By spreading your trading capital over 5 individual positions, you have effectively mitigated the drawdown on any single position. The worst or max drawdown on this SanDisk trade was minus 1.69%, which occurred at the end of step 2B. This is a completely acceptable percentage relative to a trader or an investor who simply went long only the shares back at the opening price of $35.75. Since this original PowerPoint was completed, a new charting option has been added, which is, quite frankly, the most important of all metrics and the basis for this entire application and presentation. It's called the outright stock purchase P&L. How would you have fared had you just initially went long, which is basically purchasing the shares of SanDisk from the outset or the beginning for the price of $35.75? The outright stock purchase P&L unequivocally answers that question. At the time of the strategy finishing due to having the shares called away, minus $3,850 on a stock purchase versus $3,528 with the T3 strategy. Here is an example with 3 checkboxes activated. The individual leg net profit loss shows you step by step how your strategy is faring. This is very, very useful as it allows one to see where the damage or profit occurred as opposed to the cumulative trade progression. Step 3 clearly shows the most profitable stage of this strategy with a $5,222 profit. Now remember, this must be taken into context of where the strategy was, which was down $1,694 prior to this gain. The net result, due to the shares being called away, was $3,528 in profits, which is where the cumulative trade progression is invaluable. Last but not least, we have the annualized return. Over the 3-month life of this trade, the annualized returns are just over 14%. And keep in mind that we are only using approximately 20% of the available capital, given we have diversified this portfolio into 5 similar positions or strategies in this hypothetical scenario. There is one final, often overlooked but crucial ratio that has been incorporated into the T3 application, and it is called the risk-reward ratio metric. This end value is a function of the strike price you are selling relative to the premium received. The greater this value, the better, and here's how it works. We currently are looking to open this strategy by selling the 33 put strikes, with the stock currently trading at $35.75 for a price of 73 cents per contract. This generates immediate revenue in the amount of $511. 73 cents times 7 contracts times 100 is $511. Remember, each contract is equal to 100 shares. A common mistake traders and investors make is to think that by selling a strike closer to the current price of $35.75, for example, selling a 34 put strike instead of the current 33, is superior, given you will collect more than the 73 cents in premium. And this is true, but let's dig a little deeper into this rabbit hole. Here the platform has now been populated with a 34 strike, and for that we are compensated an additional 17 cents or 90 cents in premium, raising our dollar value of premium collected to $630 from the $511. However, take a closer look at the risk-reward ratio value. It has dropped from 0.12 to 0.10. Why did this occur? By selling the 34 strike rather than the 33 in the quest for more upfront premium, you have also increased the dollar amount of margin that you need to set aside in the event that you have the shares put to you. In other words, if you are assigned the shares, you have increased the capital required to pay for them. The increase in margin your brokerage will require may ultimately not be worth it if the additional premium collected doesn't compensate you accordingly. So yes, you will secure an additional $119 up front, but the net percentage return on the additional capital is not as favorable a return. Having this metric is very, very beneficial. There are many more features and tips and tricks which have not been covered in this PowerPoint tutorial for sake of time and depth of knowledge required when trading. If you'd like to get a hold of me, I can be reached at shift618@gmail.com. Once again, that's shift, S-H-I-F-T, 618@gmail.com. I hope this has been informative, and look forward to feedback and hearing from anybody who has further questions. Thanks again.